Breaking news, global markets are rallying in a way we haven't seen in years. The world's most powerful central banks have just unleashed a wave of coordinated interest rate cuts, sending shockwaves through the financial system. The US Federal Reserve, the European Central Bank, and the Central Bank of the UAE have all lowered their key interest rates in a synchronized move not seen since the last global crisis. This isn't just a Wall Street story, it's a decision that will ripple through the lives of billions of people across continents, from major cities to small towns. Whether you're a homeowner in Ohio, a business owner in Dubai, or an entrepreneur in Europe, the cost of borrowing money, getting a loan, or investing in your future just changed overnight. Central banks are acting boldly and decisively, aiming to prevent a looming global slowdown and to restore confidence in the world economy. The US Federal Reserve led the charge with a surprise rate cut, citing weak consumer demand, sluggish business growth, and mounting economic uncertainty. The UAE, whose currency is closely tied to the US dollar, quickly followed suit, as did the European Central Bank, signaling a united front among global policymakers. The message is clear. The era of aggressive rate hikes is over, at least for now. Cheaper money is here and the rules of the game have changed. Central bankers hope that by lowering rates they'll encourage businesses to invest, consumers to spend, and economies to grow, sparking new opportunities in every sector. The speed and scale of these cuts have taken analysts by surprise, revealing just how concerned policymakers are about the risks ahead and how determined they are to act swiftly. They're not just reacting to current problems, they're trying to get ahead of potential trouble, using every tool at their disposal to stabilize the global economy. This global pivot in monetary policy affects everything: markets, industries, and the daily lives of people everywhere. From your savings account to the price of oil, from gold reserves to currency values and international investment flows, the impact will be felt far and wide. For developing nations, this is a double-edged sword. Lower rates can ease debt burdens, but they also bring new risks, like currency volatility and capital flight. We're entering a new and uncertain phase of the post-pandemic economy, where old rules may no longer apply and adaptability is key. The decisions made today in Washington, Frankfurt, and Abu Dhabi will shape the global economic landscape for years to come, influencing everything from trade to jobs. Opportunities and challenges now lie ahead for everyone, businesses, families, and entire nations, as we navigate this new era together. What are interest rates, and why do they matter? It's a question that affects everyone, from big corporations to everyday people managing their household budgets. Think of them as the price of borrowing money, a cost that shapes nearly every financial decision. When you take out a loan, the interest rate is what you pay extra. When you save, it's what you earn. This simple concept ripples through the entire economy. Central banks set a key policy rate that influences all other rates: credit cards, mortgages, business loans, and even the returns on your savings account. It's the foundation of the financial system, quietly shaping the flow of money and credit. Central banks use rates like a gas pedal and brake, raising rates to slow inflation, cutting them to boost growth. It's a delicate balancing act with huge consequences for everyone. After the pandemic, rates rose sharply to fight inflation. Now, as economic risks shift, they're being cut to avoid recession and keep growth alive. Lower rates make borrowing cheaper, encouraging spending and investment. This means families can afford homes, students can finance education, and entrepreneurs can launch new ventures. The goal? Keep people employed and the economy growing, ensuring opportunities for workers and stability for businesses. Rate changes directly impact your finances. Mortgage payments, car loans, and savings returns all shift with every central bank move. Even a small change can mean thousands of dollars over time. For businesses, lower rates can mean expansion, hiring, and innovation, while higher rates might force tough choices or cutbacks. For investors, rate changes move markets, affecting everything from stock prices to bond yields and retirement accounts. That's why every central bank decision is watched so closely by journalists, investors, and policymakers worldwide. One number, set by a handful of officials, can set off a global chain reaction, influencing economies from New York to Tokyo. The stakes couldn't be higher. Interest rates are the invisible force steering the world's economic future and your own. The first domino fell in Washington, D.C., when the US Federal Reserve made a surprise rate cut. Markets were stunned. The Fed signaled the fight was now against recession, not inflation. Countries with currencies pegged to the dollar, like the UAE and Saudi Arabia, had to follow suit. Their monetary policy is tied to Washington's decisions. This rapid succession of cuts turned a single move into a global policy shift. The European Central Bank, facing its own challenges, soon joined in. With the US and Europe easing, pressure mounted on Asia to act. Central banks in South Korea and Australia responded to avoid currency imbalances. What began as one move became a synchronized global easing cycle in days. It's a stark reminder of how interconnected our world is. Each central bank acted in its own interest, but together they pushed the world toward cheaper money. The global race for growth is on. For everyday people, when central banks cut interest rates, it's not just a headline, it means real, tangible changes in personal finances that can be felt almost immediately. If you have a variable rate mortgage or a home equity loan, your monthly payments may drop, sometimes noticeably, freeing up extra cash in your budget for other needs or wants. Lower rates also make it easier and more affordable to take out new loans, whether you're buying a home, upgrading your car, or even consolidating debt. This can open doors for families who were previously priced out of the market. Central banks lower rates to encourage spending over saving, hoping people will shop, invest, and keep the economy moving. But there's a flip side. Savers and retirees often see the interest they earn on deposits and savings accounts shrink, making it harder to grow their nest egg or rely on interest income for daily expenses. As a result, many people shift their money into riskier assets like stocks or real estate, in search of higher returns, even if it means taking on more uncertainty. For business owners, borrowing to expand becomes much cheaper. Opening new locations, investing in equipment, or hiring more staff suddenly looks more attractive and financially viable. This wave of investment doesn't just help businesses, it creates new jobs, supports local economies, and drives overall economic growth. Rate cuts act as a green light for companies to take calculated risks, launch new projects, and innovate, knowing that the cost of borrowing is lower. Investors pay close attention. Lower rates often boost stock markets and corporate profits, making equities more attractive compared to safer investments. Safe assets like bonds become less appealing, pushing more money into stocks and other higher yield opportunities, which can increase market volatility. Currency values also shift. Lower US rates tend to weaken the dollar, making American exports cheaper and more competitive abroad, but also raising the price of imports. Every investment decision, from retirement planning to business expansion, is now being reevaluated in light of the new, cheaper money environment. The new reality is clear. Cheaper money brings more risk, but also new opportunities for those willing to adapt and rethink their strategies. The effects ripple through every corner of the economy, touching individuals, families, businesses, and entire industries in ways both big and small. The world is adjusting fast, and everyone, from households to corporations, must navigate this shifting financial landscape. This isn't the first time we've seen coordinated rate cuts. In 2008, central banks acted to stop a banking collapse. In 2020, they responded to a global pandemic. Those were emergencies, fires already burning. Now in 2025, there's no single crisis, just warning signs, slowing China, weak Europe, and softening US spending. Policymakers are acting preemptively, trying to prevent a downturn before it starts. It's a tougher job, acting on forecasts, not disasters. Another difference. Central banks have less room to cut rates now than in past crises. Government debt is much higher, limiting the ability to spend big. The world faces this slowdown with fewer tools and heavier debt. The path forward is more uncertain than ever. This is a new kind of challenge, one that tests the limits of policy. The stakes are high and the outcome is far from clear. The world is holding its breath. The immediate effect of rate cuts is relief. Markets rally, borrowing gets easier, and recession risks fade. Governments with high debt benefit from lower interest costs. But this is a double-edged sword. Cheap money can inflate asset bubbles, stocks, real estate, and more. When bubbles burst, the fallout can be severe. We saw this before the 2008 crisis. Another risk, a weaker US dollar. While it helps exporters, it makes imports pricier and can fuel inflation. For emerging economies, the flood of cheap money can cause currency swings and asset bubbles. If US rates rise again, capital can flee, destabilizing these markets. These nations are caught in the cross-currents of global decisions. The balancing act is delicate. Short-term gains may come with long-term pain. Policymakers are gambling that the benefits outweigh the risks. Only time will tell if this bet pays off. Rate cuts aren't just economic, they're geopolitical. Gulf states use cheap capital to diversify away from oil. China, facing its own slowdown, now has more room to ease policy and expand its influence abroad. Russia, isolated by sanctions, benefits from higher commodity prices if the dollar weakens. Both China and Russia push for alternatives to the US dollar in global trade. Vulnerable countries like Turkey and Argentina remain at risk. Lower rates help, but instability looms. Any shift in global sentiment could trigger crises in fragile economies. The current easing cycle could increase instability on the global periphery. The world order is shifting as nations adapt to a low-rate environment. Beneath the surface, global debt is at record highs. Rate cuts make debt cheaper but also encourage more borrowing, a risky cycle. We're solving a debt problem by adding more debt. Inflation remains a threat. Cheaper money can reignite price pressures. If inflation returns, central banks may have to raise rates quickly, risking recession. High public debt means higher rates would squeeze government budgets, forcing tough choices. The world is addicted to low rates, with little room to maneuver in a real crisis. Countries like Turkey and Argentina show what happens when confidence is lost. If these policies fail, central banks will have few tools left. The system is more fragile than ever. As the dust settles, a big question remains: is this a smart move to avoid recession, or just a delay of the inevitable? The global economy is complex, and the outcome is uncertain. Optimists hope for a soft landing, steady growth, no crisis. Pessimists warn of new bubbles and deeper problems ahead. The world's superpowers, especially the US and China, hold the keys. Policy missteps or conflicts could derail recovery. The choices made now will shape our future. Are we solving the problem or just postponing it? The answer is still unwritten.